Most everyday investors believe they are being careful. They save regularly, avoid obvious scams, and try not to take excessive risks. On the surface, this looks responsible. But by 2026, this approach is quietly failing millions of people, not because they are reckless, but because they are relying on assumptions that no longer hold. The core problem is simple. Many investors confuse feeling safe with being safe. Keeping money in familiar places, savings accounts, low yield bonds, or overly conservative portfolios feels prudent. In reality, it often guarantees a slow loss of purchasing power over time. Consider a basic example. If inflation averages 3% per year and your money earns 1.5% after tax, you are losing about 1.5% annually in real terms. On a $50,000 portfolio, that's roughly $750 of lost purchasing power in the first year alone. Over 10 years, the loss compounds. That same $50,000 effectively shrinks to the equivalent of about $43,000 in today's dollars. Nothing dramatic happens, no market crash, just quiet erosion. Most people don't notice this because the account balance doesn't go down. The number on the screen looks stable or slowly rising, but stability in nominal terms is not the same as safety in real terms. Another common mistake is overconfidence in diversification without understanding what is being diversified. Many everyday investors hold multiple funds, multiple accounts, even multiple asset classes. Yet all of them are exposed to the same underlying risks: inflation, interest rate shifts, or equity market downturns. Owning five different funds does not automatically mean owning five different risk profiles. There is also a widespread belief that long-term investing automatically equals safety. Time does reduce certain risks, but only if the underlying assets are structurally sound. Holding low-growth assets for 20 years does not magically turn them into strong performers. Time amplifies both good and bad decisions. The data supports this. Over the past 20 years, U.S. inflation-adjusted returns for cash and short-term government bonds have often hovered near zero. Meanwhile, portfolios that balance growth assets with defensive components preserved and increased real wealth, but only when constructed intentionally. The difference between these approaches can amount to hundreds of thousands of dollars over a working lifetime. For example, a person investing $500 per month for 30 years at a real return of 2% ends up with roughly $245,000. At a 5% real return, the same contributions grow to about $415,000. The gap is not income-driven, it's decision-driven. This is where most people misdiagnose their situation. They assume the issue is not earning enough, not saving enough, or not having access to better opportunities. In reality, the larger issue is how safety is defined. Avoiding volatility feels responsible, but avoiding volatility at the cost of long-term purchasing power is not a neutral choice. It is a decision with measurable consequences. As we move into 2026, this problem becomes more acute. Interest rate environments, demographic shifts, and fiscal pressures make old rules less reliable. What protected capital in the past may no longer do so going forward. Before discussing solutions, it's necessary to clearly understand this mismatch between perceived safety and actual outcomes. Without that clarity, even well-intentioned investors will continue making choices that feel correct today and quietly undermine their financial position over the next 10, 20, or 30 years. To understand why this problem persists, it helps to look beyond individual choices and examine the structure around them. Most everyday investors are not making random decisions. They are reacting logically to their income patterns, financial education, and the advice they are exposed to. First, income structure matters. The majority of people in the U.S. earn active income, a salary or hourly wage that stops if they stop working. This creates a natural preference for liquidity and predictability. Cash feels flexible. Low volatility assets feel controllable. When income already feels uncertain, people try to compensate by making their investments feel stable, even if that stability is superficial. Second, behavior plays a major role. Many investors build their portfolios incrementally without an overall system. They open a savings account because it's easy. Later, they add a retirement account because their employer offers a match. Then they buy a few ETFs after reading a recommendation online. Each decision may be reasonable in isolation, but together they often form an uncoordinated structure with overlapping risks and unclear objectives. For example, consider a 35-year-old professional earning $80,000 per year. She keeps $40,000 in a high-yield savings account earning 2%, contributes to a 401k invested mostly in a conservative target date fund, and occasionally adds money to a taxable brokerage account invested in broad market ETFs. On paper, this looks diversified and responsible. In practice, over 70% of her financial assets are either cash-like or heavily exposed to the same equity market movements, with little intentional balance between growth, inflation protection, and long-term compounding. Another example is a couple nearing retirement who shift most of their assets into bonds because they were told to reduce risk. If inflation averages 3% and their bond portfolio yields 3% before tax, their real return after tax may be negative. Over 10 years, their purchasing power declines, even though they avoided stock market volatility. The advice reduced visible risk but increased structural risk. This leads to the next issue. Standard financial advice is often incomplete. Phrases like just invest for the long term, diversify, or reduce risk as you age sound sensible, but they lack operational detail. They don't explain how much risk to reduce, which risks matter most, or what trade-offs are being made. Another common recommendation is to stay in cash until the market feels safer. This advice ignores opportunity cost. Missing even a few strong market years can permanently lower long-term outcomes. For instance, missing the 10 best market days over a 20-year period can reduce total returns by more than 40%. Waiting for clarity often results in prolonged inaction, not better timing. There is also a misunderstanding of what safe assets actually do. Cash protects nominal value, not purchasing power. Bonds reduce volatility, not inflation risk. Broad equity funds offer growth, but not stability in the short term. Each tool has a role, but none work well when used as a default rather than as part of a system. The deeper issue is the absence of a clear framework. Many investors are not asking the right questions. How much short-term liquidity do I truly need? What portion of my portfolio must grow faster than inflation over decades? Which risks am I intentionally accepting and which am I unknowingly exposed to? Without answering these questions, people follow advice that sounds safe but is structurally misaligned with their actual goals. The result is not dramatic failure, but long-term underperformance that becomes visible only years later when time and compounding can no longer be recovered. Understanding this context is essential before discussing solutions. The problem is not intelligence or discipline. It is the lack of a coherent system that aligns behavior, income reality, and long-term financial mechanics. When portfolios underperform over long periods, it is rarely because people earn too little. In most cases, the outcome is driven by a small number of structural mistakes that compound quietly over time. These mistakes are common, repeatable, and often reinforced by conventional advice. The first major mistake is treating safety as the absence of short-term volatility. Many investors overweight cash, money market funds, or short-duration bonds because their values do not fluctuate much. While this reduces visible risk, it increases long-term purchasing power risk. If inflation averages 3% annually and a portfolio earns 2%, the real return is negative. Over 10 years, $100,000 loses roughly 10% of its real value. Over 20 years, the loss approaches 18 to 20%. The account balance may look stable, but what it can actually buy steadily declines. The second mistake is excessive concentration in a single type of risk, often without realizing it. For example, holding a conservative target date fund, a bond-heavy retirement account, and a high-yield savings account may appear diversified. In reality, All three are exposed to interest rate risk and inflation risk. The investor avoids stock market swings but becomes highly sensitive to changes in rates and prices. This concentration limits growth precisely during long periods when equity returns to drive most wealth accumulation. A third mistake is delaying investment decisions while waiting for clarity. Many people hold cash because they expect better entry points or more certainty. The cost of waiting is rarely calculated. If an investor delays investing $10,000 for 5 years while earning 2% instead of investing at a 6% long term return, the difference after 20 years is significant. At 6%, $10,000 grows to about $32,000. At 2%, it reaches only $14,900. The gap is not caused by bad timing, but by prolonged inaction. The fourth mistake is confusing diversification with complexity. Owning many funds does not automatically reduce risk. If those funds are highly correlated, the portfolio behaves like a single asset class. For example, holding multiple U.S. equity ETFs across different accounts does not protect against market-wide downturns. It may increase administrative complexity without meaningfully improving risk-adjusted returns. The long-term consequences of these mistakes become clearer when comparing scenarios. Consider two investors who both save $8,000 per year for 25 years. Investor A prioritizes perceived safety and earns an average return of 3%. Investor B uses a balanced system and earns 6%. Investor A ends with roughly $300,000. Investor B ends with about $475,000. The difference of $175,000 is not due to income, discipline, or luck. It comes from structural decisions repeated consistently. Over 5 years, these mistakes feel minor. Over 10 years, they are noticeable. Over 20 years, they define outcomes. Importantly, higher income does not fix this. A high earner following a weak structure often underperforms a moderate earner using a coherent system. The problem is not a lack of effort or intelligence, it is the absence of intentional design. Without clear rules for growth, stability, and inflation protection, portfolios default to habits that feel safe but produce fragile long-term results. Understanding these mistakes is critical before moving to solutions because avoiding them matters more than finding the perfect investment. The practical solution to the problems described earlier is not a specific stock, fund, or prediction about markets in 2026. It is a simple structural system that separates money by function and aligns each part with a clear role. This approach reduces risk not by avoiding volatility, but by controlling how and when different risks are taken. The first element of the system is a clearly defined safety layer. This portion of capital is not designed to grow aggressively. Its role is liquidity and short-term stability. In practical terms, this means cash or cash-like instruments that cover 6 to 12 months of essential expenses. The return on this layer will likely remain modest, but that is acceptable because its function is protection, not growth. Keeping this layer limited prevents excessive exposure to inflation. The second element is the growth layer. This is where long-term returns are generated. For everyday investors, this typically means broad, low-cost equity exposure. Instead of trying to select winning companies or sectors, the system relies on owning the market as a whole through diversified equity funds. Historically, diversified equities have produced higher long-term returns than cash or bonds, even after periods of decline. The key mechanic here is time. Volatility matters least when capital is invested for 10, 20, or 30 years because short-term losses are absorbed by long-term growth. The third element is the stabilizing layer. This part reduces portfolio swings and provides a source of funds during market downturns. It often includes high-quality bonds or bond funds with different maturities. Bonds tend to behave differently from stocks, which helps smooth returns. This does not eliminate risk, but it reduces the likelihood of being forced to sell growth assets at unfavorable times. The system works because each layer has a defined job. Cash handles short-term needs, bonds manage stability, and equities drive long-term growth. When markets decline, the investor draws from the safety or stabilizing layers instead of selling equities at a loss. When markets perform well, gains in the growth layer are periodically rebalanced, meaning some profits are shifted back into the stabilizing or safety layers. This creates a disciplined process that does not rely on predictions. This structure is stable because it is rule-based. Decisions are made in advance, not in response to headlines or fear. The investor does not need to guess interest rate moves or economic cycles. The system adapts automatically through rebalancing. If equities grow faster than planned, they are trimmed. If they underperform, new contributions naturally increase exposure at lower prices. Importantly, this approach does not eliminate risk. Instead, it makes risk intentional and measurable. The investor knows where volatility exists and why it exists. Over long periods, this clarity reduces behavioral mistakes, which are a major source of underperformance. For 2026 and beyond, this system remains effective because it is not tied to a specific market environment. Whether inflation is moderate or elevated, whether rates fall or remain high, the structure adjusts without requiring constant intervention. Stability comes from alignment, not prediction. When the previous parts are combined, the result is not a prediction about markets in 2026, but a clear operating system for long-term investing. The core idea is simple. Money must be organized by purpose, managed with predefined rules, and evaluated over realistic time horizons. Without this structure, even conservative investors unintentionally take risks they do not see while missing the returns they actually need. The complete system has three permanent components. First, a safety reserve covering 12 months of essential expenses held in liquid instruments. Second, a growth allocation focused on diversified equities designed for long-term appreciation. Third, a stabilizing allocation that reduces volatility and provides flexibility during market stress. The exact percentages can vary by age and situation, but the logic does not change. Each dollar has a job, and no single asset is expected to do everything. What changes over time is not the structure, but the outcome. After 1 year, the primary difference is behavioral. The investor is less reactive to news because short-term needs are already covered. Market volatility becomes manageable rather than disruptive. Financial decisions become procedural instead of emotional. After 5 years, the impact becomes measurable. Regular contributions combined with disciplined rebalancing typically result in a portfolio that grows faster than inflation while remaining stable enough to avoid forced selling. At this stage, many investors notice that their net worth is no longer driven only by savings, but by compounding. The system starts doing more of the work than income alone. After 10 years, the difference between structured and unstructured investing is substantial. Portfolios built around cash-heavy, safe strategies often struggle to maintain purchasing power. In contrast, a balanced system with consistent equity exposure tends to show clear, real growth. At this point, flexibility increases. The investor can adjust goals, reduce risk gradually, or redirect capital without destabilizing the entire plan. The practical steps to start are straightforward. First, calculate essential monthly expenses and set a target for the safety reserve. Second, review current accounts and categorize each asset into safety, growth, or stabilization. This often reveals overconcentration without requiring any new investments. Third, define a simple rebalancing rule, such as reviewing allocations once or twice per year and adjusting back to target levels. Fourth, automate contributions where possible. Automation reduces decision fatigue and improves consistency. This approach does not depend on timing the market or selecting exceptional assets. It relies on alignment between time horizon, risk exposure, and financial objectives. The system works because it removes ambiguity. Each part has limits, expectations, and a clear reason to exist. For everyday investors in 2026, the main risk is not choosing the wrong investment. It is operating without a structure that can absorb uncertainty. Markets will continue to fluctuate, policies will change, and forecasts will fail. A well-designed system remains functional regardless of those variables. The goal is not optimization in any single year. It is durability over decades. When the structure is clear, decisions become simpler, outcomes become more predictable, and long term investing becomes a process rather than a constant problem to solve.